This coming week sees a raft of data coming out of the UK in particular, whether it's the jobs data, inflation, retail sales, you name it, you're going to get it. And so it gives us an opportunity to look at exactly what the state of play is at the moment, see the outlook for the Bank of England, and see how things could shift in terms of the FTSE 100 and cable. So we can see here that essentially you have things really kicking off on Tuesday with the jobs report. Unemployment expected to remain at 5.1. Average hourly earnings expected to decline across both the total figure and the excluding bonuses figure. That, of course, has disinflationary effects. Then you have the claimant count, where it's expected to remain fairly steady compared to where we were in November. So not necessarily a huge amount of movement expected from the Tuesday jobs report. Then on Wednesday, you've got inflation expected to decline on both the headline and the core year-on-year figures down to 3.1% from 3.2. That's thanks to a 0.2% metric across both of them for the month-on-month numbers. Then you've got the retail sales figures and the PMI numbers coming out on Friday. In terms of the inflation gauge, what's notable here is that we have got a disinflationary pathway ahead of us, bearing in mind that we previously last year saw a major bump in April off the back of a number of different factors, but one of them is off the back of the budget from the Chancellor. She decided to raise national insurance contributions for businesses and up the minimum wage. And she thought that that would be a good idea, despite the fact that we're, of course, trying to get inflation back down to a level where we'd allow the Bank of England to do their work. Well, that's not what's happened. The Bank of England have lagged essentially because of that, with inflation currently above 3%. Of course, the 2% target feels some way away, but if you look at the 7-month annualized figure at the bottom, you can see that in just 5 months' time, once that April figure drops out, and you can see in the middle quite why it's so important, you've got 1.2 and then 1.4 across the headline and core metrics for that month alone. Once that drops out, we see a normalization coming into play. Understand that we have, of course, recently seen the autumn statement, the latest budget from Rachel Reeves, and the projections point towards a 0.5% decline in terms of inflation for the year ahead, thanks to that budget. So she's gone from being inflationary to really learning her lesson and trying to be deflationary for the year ahead. That 7-month annualized figure now standing around 1.7, 1.8 kind of area. It really does signal a decline in a pretty dramatic fashion, in particular around that February, March, and then April time. So Q1 coming into Q2, that's when I expect disinflation to really kick in. That's when I expect the Bank of England to take a significantly more dovish approach to things. And for the time being, it's difficult to know exactly whether we will see that stance, because ultimately inflation, if you don't look at these monthly metrics, if you just look at the year-on-year numbers, it's still well above where they need it to be. In terms of the jobs market, we have seen a rise in the more recent claimant count figure, with a rise also in the unemployment rate. So that signals something for the Bank of England to be concerned with. They don't necessarily have the dual mandate that covers both the jobs market and the inflation gauge as they do in the US, but nonetheless, it's certainly something they will be paying very close attention to. But markets at the moment are pricing in the idea that we're going to see essentially flat unemployment, and the claimant count again similarly kind of same area that we were previously. So we're not expecting much on that front. I thought this was interesting to show you guys. What we have seen recently is a sort of gradual, steady decline in terms of borrowing costs in the UK. Following the autumn budget, of course, you saw an initial decline after that budget, and then you saw a bit of a rebound since then. Well, it's sort of rolled over a little bit then. You could say that that takes some pressure off the Chancellor, but we've more recently started hearing about a massive black hole that's starting to develop once again, this time around thanks to the demands of the Ministry of Defence, which apparently wasn't factored into the budget last time around. Keir Starmer's furious, apparently, but we might be back in the same position as we were before. But certainly if we do see yields moving towards the downside, like you can see here across both the near end of the curve and the long end of the curve, that at least provides the basis for a little bit of a more calm approach, following that sort of rampant rise that we had been seeing in borrowing costs in the UK, and the concerns of what that's going to do in terms of the debt pile and future budgets from the Chancellor. In terms of the UK GDP figure, this also surprised recently because we've seen a rise of 0.3 for the month. And this, of course, flies in the face of the norm that we had been seeing in the prior months. Part of it came down to a reversal of the sort of shutdown that led to a sharp decline in terms of the Jaguar Land Rover output because of a cyber security issue they had. And so we did see a bit of a bump from that. But certainly things appear to be sort of improving a bit in terms of the GDP numbers. Certainly by no means is the UK in this incredibly strong position. I would say if you've got inflation sort of around 3.2, and yeah, ticking a little bit lower, but still 3.2. The jobs market, we have got some concerns around, but then sort of yields moving lower, so it takes a little bit of the pressure off the Bank of England to have to cut rates to try and drive borrowing costs lower. And then GDP sort of eradicating some of the weakness we have been seeing in previous months to move up 0.3 for the month. That does point towards a possibility of a sort of cautious approach from the Bank of England. Now, in terms of market expectations, I've just realized that I didn't actually add that slide. It's somewhat stupid of me, quite frankly. But nonetheless, I will be able to read it to you exactly what we're looking at in terms of the outlook for the Bank of England. So bear with me 1 second. Just got to bring it up on my own platform. There we go. There's the US, here's the UK. All right, so basically, as things stand, markets are pricing 0 in terms of the movement. Well, 0, I say that. 6% chance of a cut in February, 36% chance of a cut in March, 59% chance of a cut in April. So markets are pricing the next rate cut coming in April, bearing in mind that I said at the back end of Q1, at the beginning of Q2, that's when we're likely to see inflation falling in a meaningful manner. But what's notable is that essentially markets don't really see much beyond that. So, we're going to see maybe one more cut, that's not really all that. So, the question mark is, do we see a sharp decline in inflation takes us into a position where we see the Bank of England really want to cut rates in a meaningful manner? Of course, they'll be at like 3%. Is that the terminal rate? Certainly that's going to be the key question. But if inflation does drop to, we're talking about 1.7, 1.6, does that provide the basis for them to be more proactive? Bear in mind that these central banks will want to keep their powder dry as well. They need to have something left in the tank for when things go sour down the line. You don't want to have 0% as your standard rate. So yeah, where do we end up? That remains to be seen. But certainly inflation, I think by the end of the first quarter, particularly sort of beginning to midway point of the second quarter, that's when we really see that disinflation kicking in. And then you see the possibility of the Bank of England taking a more proactive stance. In terms of the markets to watch, we can see here the FTSE 100 has been doing very well of late. I think Donald Trump, despite his sort of America First approach, he has provided the basis for people to think they need to diversify. And in actual fact, the UK has been doing particularly well because of the focus that we have in the commodity sector. And again, Donald Trump, it's all about looking after yourself. Well, every country seemingly feels the need to start stockpiling different assets. And therefore, people are really realizing this is a year that you should be looking after the sort of strategic metals, minerals, things like that, right? So silver doing particularly well, copper doing particularly well. So Fresnio, Antofagasta, those kind of names have been on the rise. And you've got the defense names doing very well. So certainly, I think this trend is likely to continue in my mind. At some point, you might see a sort of fade back in towards trendline support, but we have got this sort of ascending channel at the moment. Towards the top end of that, we have got this wider channel, wider trend line resistance that could come into play as well. But unless you start to break down through some of these near-term swing lows, a more recent one is 10096, but the most notable one is 9997. If we start to break those levels, yeah, then it starts to look different. But until that happens, I think it looks like we're going to see further upside to come. This is an interesting one. So you've got cables at a pound against the US dollar. The wider context looks something like this. So you've got wider bearish trend, but then over the near term, you could say, okay, well, we're in this sort of bullish trend over recent years. But are we in this sort of bearish phase at the moment? Certainly you can see that we're potentially rolling over here, which sort of plays into this. So you have got a number of different trends depending on what time frame you're looking at. And so, are we retracing from a resistance level? Well, let's look in terms of the fibs. And you can see slap bang on the 76.4 fib, and we've been rolling over, most notably taking out your sort of neckline here at 1.34. So now we've got this creation of lower highs and lower lows. That signals the possibility of further downside to come. And in particular, if we see weak data in terms of the jobs data or in terms of the inflation data, it provides the basis for additional hopes for a rate cut in March, which currently we're seeing the base case scenarios as coming in for April rate cut. So that, if we did see that data coming out like that, if we saw weak data, it points towards near-term upside being sold into once again, with a rally through 1.394 needed to start to build a bit more of a positive picture following what looks like a topping pattern here for cable. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst. Have a great day and good luck trading. Thank you.